Yo, I think I'm online here. I said I think. I can't tell because I can't see what's going on. My Twitter page didn't update to say that it's streaming. All right. Anyway, let's just start. It is recording. So what I'm going to do here is I'm going to share my screen. And I'm going to talk a little bit. Cool. So let me begin with to tell you what I'm going to talk about today and why. So one of our users that uses Moontower AI, he reached out and he had explained that he sold these slightly in the money calls on a name, and he thought he picked slightly in the money calls because they have a little bit higher delta, and he was directionally bearish, and he thought that the vol was too high, the option premium was too fat. So he asked me, let's kind of read here what he said. I decided to short the slightly in the money uh, blank strike calls. While I was immediately correct on the directional component, I'm not too sure if I was correct on the volatility component. How do I determine or assess this? So this cuts right to the heart of something that I harp on a lot, which is that options are about volatility. And I think that when people first get introduced to options, they think of them as leveraged, basically leveraged directionality. So I'm going to buy calls if I think the stock's going to go up. But if you look at an options pricing formula, there's a bunch of inputs there, and some of those inputs are, things like moneyness and interest rates and strike price, and I guess that's kind of moneyness. But the major thing, right, is the volatility, and the volatility has is a large contributor to the value of the option. So if you just use options for directional reasons, you're actually taking on this basket of risks that are not just directional. You're taking the volatility risk and the time risk also, and that's really sort of one and the same. The volatility risk and the time risk, you can kind of think of them as two sides of the same coin. If a stock can go up 10% in a month, versus, it's like the risk is that the stock, if you buy those calls and you think the stock can go up 10% in a month, then it takes 2 months to do that. You could say, oh, I lost because I got the timing wrong. But another way of saying that is you kind of got the volatility wrong, because you thought it could go 10% in 1 month, and it turned out to not be as volatile as that, and it would take 2 months to do the same kind of move. So volatility and time can be the same sides of the same coin. Anyway, so to answer his question, remember, he wants to know, how do I know if I was right on the volatility component? Now, uh, so I figured, let's, instead of just giving the answer, let's try to feed a man, or what is like teach a man to fish, and show a framework for how we could actually figure out if our vol trades are correct on the vol component of what we're doing. And by showing you the framework, you can see how you would have to step through this problem and understand if your vol trades are actually working or not, and see how to. It's really what we call it. You're decomposing the P&L, so we can decompose the P&L into your volatility P&L instead of looking at your delta P&L. A delta P&L can always be sterilized. What we care about is the volatility P&L, and we're going to go into what makes up a volatility P&L, and I'm going to show you a tool that I made here that will kind of demonstrate a lot of the ideas. So we'll start with First of all, let me talk about volatility, what volatility P&L actually is. So I think of it as two ways, or made up of two things. It's made of you have the realized volatility component, and then you have the implied volatility component. So if if you're long a call, if you're let's say you're long a straddle, and the straddle is priced at 16% vol. So 16% vol translates to about 1%, a 1% change in the stock per day. So let's say you own a and that straddle is also going to have a vega. What is vega? Vega is the change in the straddle price for a 1 point change in vol. So if the vol is 16 and vol goes from 16 to 17, so up one click, that straddle will expand in value by its vega. So let's say today I buy this straddle at 16 vol, and tomorrow, let's say the market goes up. I have a delta neutral position, so I buy the straddle, or we say I buy the delta neutral straddle in this case. You could also have been synthetically long a straddle because you could have, if you bought 100 call options and sold 5,000 shares against it, that would be equivalent to being long a straddle, because you could think of that as, well, I bought 100 calls and I turned 50 of them into synthetic puts. Because if I'm long 50 calls and short 5,000 shares of stock, that is exactly a synthetic. That's exactly a synthetic put. So if I have 50 synthetic puts and then I have 50 real calls, remember the 50 other calls that are not matched with shares, I have 50 real calls, I have 50 synthetic puts. That's also a straddle. So let's say we'll just use the straddle. So let's say I'm long these straddles. They're 16% vol straddles, and tomorrow the stock goes up 1%, and the volatility expands. Let's say the volatility expands by 1 point from 16 to 17. I'll just make up a number. Let's say the straddle vega is 10 cents. So if the straddle yesterday was $3, today the implied vol, based on the implied vol, that straddle will be worth 310 due to vega, basically vol expanding. So you would make a dime on implied vol. However, you also have a realized vol P&L. Every day you have a realized vol P&L, and that realized vol P&L is the tug of war between your gamma and the cost of the gamma, which is the theta. So if you own 16% vol, like I said, translates to 1% a day. So if the stock moves, and this is pretty approximate, but if the stock moves 1%, your realized vol, your delta, meaning your gamma P&L, will offset your theta P&L. So you will make as much money on your gamma as you lose on your theta. So in this case, your gamma and theta P&Ls will offset each other, because you can think of a little bit of theta as like renting every day's realized move. So so those would offset each other. So your realized vol P&L would be zero. Your implied vol P&L, which would be based upon what happened to the implied vol, that would be making a dime. So your total vol P&L would be making a dime on this $3 straddle. Had the stock not went anywhere, it was completely unchanged, your realized vol P&L would have been losing your entire theta on the straddle, but you would have gained a dime on your vega. So your implied vol P&L would be plus 10 cents, and then let's say your straddle, let's say your theta was 9 cents on the straddle. So your net P&L would be a penny, and you would have had negative 9 cents of realized vol P&L and positive 10 cents of implied vol P&L. So, and all of this assumes we started with a delta neutral position. So, if you had a delta, you could have attributed delta P&L as well, and you could have said, oh, let's say that I have these, I own these straddles, and I also own 1,000 shares of stock. And in the case where the stock went up 1%, you'd make 1% on 1,000 shares. And that would just be your delta P&L. It's complete. So we can completely separate your delta P&L, which would be your day's starting delta P&L, from your delta neutral or options P&L. And your delta neutral P&L, that's your vol P&L. And again, it's made up of a realized vol and an implied vol, and that sums together to be your vol P&L. That's, and looking at your vol P&L, that's going to determine if you're going to be making or losing money on vol. So that gets to the heart of the question here, is really, how do I know how do I assess the vol component of what I'm doing? If I sell this option and I make money because the stock went down, how do I know that selling that option was a good trade versus just having shorted the stock? And the answer to that would come back to, well, you need to look at your vol P&L from the trade. And then you can say, okay, well, I made this much on my delta. I made maybe I made $2 on delta, and maybe I lost 30 cents on vol. So I made $1.70 net, but that's because but all of that and more than all of that is coming from the delta P&L. So you could say there I was directionally right and I was vol wrong in this case. So even though your P&L was positive, we care about knowing, was the vol trade a good trade, or was the directional trade the good trade? And this is, if you're trading for the purposes of vol, this is it's really not optional to do this. Like this is you have no idea if you're doing the right thing or not if you're not paying attention to your vol P&L. If you're trading options with a vol lens. I mean, this is the equivalent of this in regular investing is if you bought a basket of stocks and you made a bunch of money, you would say to yourself, well, did I beat the market or not? So if the whole market went up and I made less money than the market, then you actually you could say that you destroyed value by actually being actively picking the stocks that you picked. So you made money on beta and you lost money and you had negative alpha, I guess is how we would say explain that. So this is the same thing. You're really separating vol P&L from delta P&L the same way a regular investor would separate delta P or beta P&L from alpha P&L. Okay, so let's kind of get into how I approached this. This is okay. So what I did is I made a simulation. So let me actually talk through this a little bit. So this is, I did this in Excel 365. The cool thing about Excel 365 is it has this function up here. It's kind of like it writes in these light gray letters, but there's a function in Excel 365 called stock history. And it will actually pull the historical data from, I actually don't know what the source data is, like where Microsoft gets that source data. I don't know who provides it, but you can get a stock history from just this simple function in Excel. You can't do it in all versions of Excel. I pay the annual fee or whatever for the Excel 365. I think there's another modern version of Excel where that's embedded in it as well. But anyway, it's a very handy little tool in here. So you don't have to, if you don't want to go like write a Python script to get Yahoo Finance stock prices or something. So, okay. So right now what I did here is I just picked USO. And what we do is I type in USO here, the stock history kind of populates itself. And then it automatically goes and grabs the first. So in this case, the first price is this is 11/1/2024. This price, it closed at 72.02. So this thing automatically says, okay, let's look at the 72 strike, like the at the money strike on that day. And what we do is we do a simulation where, so the stock price is not simulated. This is the actual stock price, daily closes from 11/1/2024 until Actually, let me see, till yesterday. So this is as of last night's close. So this will automatically populate up to last night's close. You could put in a separate end date if you want, but that's how what it's doing right now. Okay, so and what this is doing is saying let's look at the 72 strike, and then what we're going to do is we're going to pretend that let me see what I did here. I said, okay, I'm selling contract quantity is minus 100. I'm going to sell 100 puts, and it's going to be the 72 strike. I could have overridden the strike, by the way. I could have said, I want to pretend that we sold the 65 put. Doesn't matter. But in this case, it's just picking the at the money strike. It says I sold 100 of the 72 puts, and what we're going to do is we're going to delta hedge. This simulation delta hedges acts as if it was delta hedged on the close every day. So, okay, now what vols are we using for this, right? Because we have to kind of put in some vols. So what I did was I wrote a very, very naive vol, like a vol model. It's like, how does vol unfold here? And what I did is I basically had it specify an at the forward. You can think of it as at the money. It's technically at the forward, but that's not that little wrinkle is not super important. And you can think of it as this is the vol that's and it's a function of a VRP that the user, an average VRP that the user specifies. So I put that in here as like mean at the forward VRP. So I'm just saying that I'm going to, based upon the realized vol, I am going to pretend that the at the money vol starts at, on average, 10% higher than the realized vol. I could change this. So that means if the realized vol was 20%, then the implied vol would be seated at 22%, right? 10% premium to the realized vol. So, and what happens there is that function then, as the stock moves around, the realized every day we're going to have a new stock price, which means that every day our trailing volatility, realized volatility, and which is I kind of set this window up here. I have a little thing here. So I put a 5-day window. So we're just calculating 5-day realized vols. So it says, okay, today's realized vol is now this number because, 5 days ago number drops out of the sample, and then we get a new day. So every day the realized vol changes by a little bit. And then the implied vol changes as a function of the realized vol. With it, there's a random element in there that's this VRP noise percentage. Basically, like I said, that's why I'm saying it's a 10% vol premium on average, or if you set it to be a 20% premium, that would be on average. But I put a random noise attenuator in here to kind of make it not so deterministic. And then from there, so your daily changes in vol are based upon how the realized is sort of unfolding. And then what you have is, and then I have a little skew model over here. And from the last video, which is the first tab on this sheet was you guys will recognize this from the last video. Same kind of vol model, a floating skew model where I have breakpoints. So we have the at the money, which is kind of here in the middle. And then you have one standard dev up, 2, 3, and then one standard deviation down 2, down 3, and then how much vol premium or discount to apply at those grid points. So here the calls are all the same. The out of the money call region of the distribution is all using the same vols as the at the money, and then the puts there's a skew here. So one standard deviation down, the put skew is you could think of it as 108% of the at the money vol, or the 2 standard deviation down is 115%. So that's our skew model. It's a floating model, and we know these parameters never change. But now think of what we have. We have a stock price that changes every day, we have a function that says this is what the implied vol will be, the implied at the forward vol will be on that day. And then we just apply the skew model to that at the money vol. And from there, we now have a history, a simulation of the 72 strike over time, because look what happens here. So as the stock moves around, we can see here that at the forward prices, it starts at 73.14 and it goes up the next day. So what happened? Let's just think about what's happening to this one strike. So this 72 strike started out as it started out as a 43 delta. All right, this that was basically an at the money put, started out as a 43 delta put. And when the stock went up from 73.14, it went up over $2, that put becomes more out of the money, right? And what happened is the at the forward vol, first of all, that changes a little bit. And then we apply skew, because now it's rolling up the skew curve a little bit, because now it's an out of the money put. Its implied vol is going to get a bump relative to the at the money vol. And so what we see here is our original strike vol was 29.6. And then the vol in the simulation goes up almost 3 points on that strike. So our at the money vol went up, went up about 2.6 points. The at the money vol went up 2.6 points. And because of the skew, the strike vol on that particular strike went up about 2.9 vols, right? So it went up a little bit more than the at the money vol went up. Okay. So this is how the simulation works. So here's a new at the forward vol every day, and then we just apply the skew model to it. Now what we do is we say, let's hedge this every day. So on the first day, remember, it's a 43 delta put. So we're going to go here, and this is and it's 100 contracts. So we're going to be hedging that put. So we're going to have to, if we're short this put, we need to be short stock against the put. So for 100, we're going to need to be short 4,300 shares of the stock. So you can see here our hedge shares. So here's by the way, this is the option Greeks for that strike on that day, given that this IV that we're computing from the model. Okay. This is the Greeks that are spit off by that implied vol. And then this is our position weighted Greeks, which all that means is, well, I'm short 100 contracts, so I have to multiply all of those Greeks by 100, and then I have to multiply it by 100 again, because the underlier for any equity option is 100 shares. And then here, this tells you our portfolio. So we have to be short for 4,290 shares, which is about 4,300 shares. And then every day we just step through the simulation and we pretend that we delta hedged at the closing price. And then we can look and see, this is pretty straightforward. The stock P&L is just what was our share position as of last night when we were delta neutral until today. So today is Wednesday, February 19th. So if this was yesterday, I was short 4,300 shares. The stock did whatever it did. So I can see my P&L on the stock side. My option price changes. So the option price will have changed because, remember, we now know we have an implied vol for that option. The day is forward one day than it was yesterday. So we have all the inputs we need to compute the option on the next day. So the option P&L is here. But now we want to separate out what are the different components of that option P&L, because in this case, the stock went up 3% from 72 to 74.29 roughly. So the stock went up 3%. So that option is going to lose, those puts are going to lose value, and you're short those puts, but you're short stock against it as well, right? So overall, your portfolio P&L was just $55, right, on this delta hedge position. And let's see how it came out. Let's see how we got to that $55. So you have your gamma P&L, which I went through in the last video, but your gamma P&L is the change in the stock price squared times your gamma. Like, so last night's gamma times your change in stock price squared, and that whole quantity divided by 2. Again, I explained that in the video last time, and it's actually all explained on another tab in this sheet. So you have your expected gamma P&L based on the stock moving $2 and how much gamma you had yesterday is losing $685. Then of course that makes sense because you're short options. So if the stock moves and you're short options, your gamma P&L is always negative. If you were long options and the stock moves anywhere, your gamma P&L is always positive. So you have a negative gamma P&L, which is correct. We got the sign right, and that's the number. And then we have our realized vol P&L. So the realized vol P&L says, well, you lost $685, but that's only half the ledger. That's just your gamma. How much did it cost? Or in this case, how much did you collect for being short that option? You were short gamma, you should be paid for that. You're paid in theta. So if we lost $685 in gamma P&L, we only made back about $160 in theta, because our total realized vol P&L is just your gamma P&L plus your theta P&L. So in this case, it's here explicitly. Your nightly theta on this position is making $164 a night in theta on being short these 100 puts, but you lost $685 in gamma. So if we sum those together, we can see that the rent you were collecting to be short this gamma was not enough to cover the size of the move. And that makes sense because the implied vol was, if we look back here, the implied vol was 33.6. By the way, the spreadsheet keeps, I could turn calculation off. I don't really want it to, okay. That's a little annoying because it makes this automatically crosses all these out, because if the calculation's off, then Microsoft kind of gets worried. It's like, hey, you're looking at stale data, but it's okay. We can look past the strike throughs. So the reason you lost is because we moved 3%, but the vol was priced at 32%. 32% implies a 2% move per day. So if you move 3%, you're going to lose money because you moved more than what is implied. So these numbers kind of all changed a little bit because of the recalc on the simulation, but now they won't update anymore. So the gamma P&L is losing 662. Your theta P&L in this case was making 170. Your total realized P&L is losing just about $500. So the realized portion of your vol P&L is negative. Now, what happened to Vega? So let's go back and look at the vol on the strike. The strike vol went from 33.6, and it actually went down to 32.5. So you made 1.1 vol points. In your Vega, remember your short options, so your position Vega was you were short 1,730 Vega, and you made 1.1 vol points times that. So you made about a little over $1,700 in Vega. So and that's your Vega P&L. So this is you were making $2,000. So instead of making $7,000, you made $2,000 in Vega P&L here. So you made $2,000 on implied vol. You lost $500 on the tug of war between gamma and theta. So your total sum P&L, theoretically, is that you should have made $1,500 on vol P&L. And let's just reflect on like what that means. Again, this has nothing to do with what your initial delta. Remember, your initial delta was 0 going into this. You were short an option. The stock made a pretty big move compared to the vol that you were short. So you lost money on the realized vol, but vol came in and you ended up making $1,500 total because the Vega, what you made in Vega, overwhelmed what you lost on realized vol. Now, this is our theoretical guess as to like what I think the P&L would be. But we actually have a real option P&L, because remember, we can just remark the option the next day from the where it was yesterday. And in that case, what we discover is that our actual P&L ended up being even higher than the theoretical P&L. Your actual P&L was that you actually made $2,000 roughly, even though we predicted that you would only make $1,570. So you actually made an extra $450 here. That is that difference between what your actual P&L was and your predicted P&L based upon your Greeks. That you can call that an unexplained P&L. You can call that a residual. I use those terms interchangeably. So you may ask, like, why is there even a residual? Like, how come the predicted or theoretical P&L doesn't line up exactly with what happened? And the reason for that is because we're not looking at all the Greeks. We're not looking at all the ways the Greeks change. Remember, yesterday, your theta on that option, that was an at-the-money option yesterday. So it had a certain amount of theta. But as the stock moved away from the strike, the theta will decline. All else equal, the theta will decline because you're no longer right at the strike. Similarly, your gamma will also decline. You will not be short as much gamma. So notice in this case, it's exactly what's happening here, is that my guess as to what happened is that your gamma theoretical gamma P&L assumes that your gamma quantity was constant throughout the entire move. But if the further you move from the strike, the more your gamma itself goes away. Like an option that is 30% out of the money doesn't have any gamma. So your gamma was not constant over the move and actually declined as you went further away. So our negative gamma P&L is overestimated because we didn't have as much gamma throughout the entire move. Your vega P&L could have also been somewhat overestimated because the vega of that option, we can look, the vega of that option on the day it was initiated was 17.3 cents of vega. So meaning that for one vol, vol increased by 1 point, that this option's value would go up by 17.3 cents. Your vega by the end of the next day, because now the option is out of the money. It's only the next day the option went from a 43 delta to a 37 delta. Your vega is only 16.98 cents. So your vega declined a little bit. So if vol came in, I wouldn't have expected to make the full amount of the predicted P&L. I would make a little bit less because I wasn't quite as short vega anymore by the end of that move. This and basically this unexplained P&L is, and also there's all these cross Greek effects that, again, like it's not, we don't want to be too concerned with that, but your cross Greek effects is like, for example, as your vol comes in, the gamma of an option kind of increases, right? So there's like a cross Greek there. It's like your Vanna. So if you were to do a full attribution, you could actually, and this is like you've ever heard like a Taylor expansion applied to this idea of decomposing your vol P&L. That's what this is about. Like you could go out many terms and do all the cross Greeks and say, okay, well, how much money did I lose to Vanna or make to Vanna? And like you could really decompose all the Greeks. However, you will find that typically your gamma theta vega explain so much of the P&L that the rest of it is just kind of can just be looked at as noise. And for this is definitely true for basically anybody that this is not their entire livelihood, is trading these things down to the penny as a high volume options trader. So I don't think you need to decompose any more than theta vega gamma, but decomposing that much is incredibly revealing, right? So we learned here that, okay, we lost on realized vol P&L, we made on vega P&L, and we net ended up making money on this position for that day. So that's basically stepping through one day. So all we do is now we just do this for the simulation does this for every single day. And we can just pretend, hey, let's delta hedge this position every single day at the close. And we end up with nice little charts. So this purple line here is your cumulative hedged P&L. So this is your delta neutral P&L every day. This assumes that you start the day delta neutral, the move happens, and then you rebalance again back to delta neutral. So over time, in this case, we see that this is what your hedged P&L looks like. So if you were short 100 of these contracts, you were up $18,000 on a delta neutral basis. One thing I would point out, forget the delta neutral for a second, and let's just say, well, what if I just sold 100 of these puts and didn't do anything else? So if I go back here, remember we sold this option at, if I could just figure out where the option price actually is. It's here somewhere. Well, it's got to be here. Let's see. Oh, there it is. The option started at $5.40. When it was an at the money put, it was a $5.40 option. The stock, USO stock price, over the time of from 11/1 to yesterday, it was up about 6.6%. So those you would have won on direction by being short these puts because the stock is up 6% since you traded it. So if you sold the put at 540, as of yesterday, that put would have been worth 73 cents according to the simulation. So that's you would have made $4.70 roughly, $4.70 times 100 contracts. So you would have made $47,000 if you just sold these puts naked. So if you sold the puts naked, you would have made $47,000. If you delta hedge these puts the entire time, you made $18,000. Which that disparity is, there's nothing especially notable about that. It's obviously if you sell a put and the market goes up and the vol hasn't done something absolutely insane to the upside, then you're going to make money. So here on a delta neutral basis, you made $18,000. So in this case, we could say that if you sold those puts, you were not only directionally right, you were also vol right because you made money on a delta neutral basis. This is the answer. This is the answer to the original to the original question, that how would you know if your vol trade was a good trade? And the answer comes from doing an attribution and looking at your hedged P&L over time. I'm going to talk about that a little bit more, but I want to just point out what these other charts do. So this is just saying, what's my P&L, my P&L every day, scaled to the move in vol. So, scaled to the move in the underlying name. So in this case, this x-axis is in standard deviations. So you can see when the stock, your short options, if the stock does not move more than one standard deviation, you're usually making money. And when it does move more than one standard deviation, you're usually losing money down here. And you can kind of see how this works. You make, if I'm being, I don't know, if I just kind of like draw an imaginary line here, it looks like maybe you're making on average something like $700 on the days when the stock doesn't move more than one standard deviation. And then, you're losing about 3 times as much on the days that it does. So, in this case, if you're making 3 times as much, if you're losing 3 times as much on the days when it moves more than one standard deviation, well, those days happen about 32. If log returns are normally distributed, you expect that the stock will move more than one standard deviation about 33% of the time. So you should expect to lose. So it's not surprising that that's what the ratio looks like of how much you lose to how much you win. You should lose a couple multiples of a typical winning day on those losing days, because those losing days only happen, say, less than a third of the time. So that's just more like for intuition. That's not really, I'm not saying something sort of like that's a rule or scientific there. It's just to think about how the wins versus losses would be distributed, how they should be distributed, what you would expect. Okay, down here, this is the attribution for every day. So we get the total theoretical profit every day. This is, you know what? Let me see if I can change that color, because, yeah, that's a little easier to see. So every day we can break our P&L into your total theoretical profit, your implied part of your P&L, your realized part of your P&L, and then the residual or unexplained portion of your P&L. And what you will find is the residual, the gray lines. Actually, this gray line was a pretty big one. You will find the occasional day where the gray lines are very large, and those are days. My best guess there is those are the days where the stock has made a large move, and the Greeks that you thought you had as of yesterday's close went away or gained as you went away from the strike or towards the strike. Remember, your Greeks are not constant over the move, but they will vary according to whether you get closer to the strike or further from the strike, or the way the way vol changes. So the residuals will tend to be that unexplained P&L that is coming from something like either Vanna or vol of vol or Volga. So maybe you're short Vega, and your Vega, you actually become shorter Vega over the move, so you underestimate the vol P&L portion from the prior day. So that's what the unexplained P&L is kind of capturing on those days. And it will tend to happen on a large day when your higher order Greeks are having a larger impact on your P&L. Okay. Let me talk about a couple of practical things here. So, yeah. So here's kind of a thing to point out. So in this case, we're talking about, like, it's almost a 6-month option. I'm saying that I'm starting on 11/1/2024, and with an expiration of March 22nd, 2025. So it's almost a 6-month option at inception. An option with 6 months to go, or a year to go, or like a long time to go, its P&L will be dominated by the Vega P&L, because the Vega of those options is going to be large, and the vol and the gamma and theta from an option that has a long time until expiration is relatively small. So when you have a long time to expiration, you expect your Vega P&L to dominate, and that's those yellow. And you can see this here; it's kind of cool. The yellow lines are your implied vol P&Ls. You can see how early on, this is November, December, your yellow lines are larger in magnitude overall, because your implied vol P&L is what's dominating your overall P&L. And as you get closer to expiry, the impact of the implied vol P&L starts to decline. This can also happen if you're getting far away from the strike, but that would be true for all the Greeks. So yeah, the more important principle here is that your implied vol P&L becomes less important as a contributor to your P&L as versus your realized vol P&L. And this kind of gets to this idea of why, when you're thinking about an option with, say, 6 months to a year to go, you want to think in terms of implied vol. If you're thinking about an option with a week to go, you're really thinking in terms of straddles. It's almost like a phase shift thing for me, like solid to a liquid. I don't even, with 1 week to go, I'm not even really thinking about vol, like an IV number. It's just, what's the straddle price? What does it imply for a daily move? And kind of comparing that with how the stock is kind of moving around. And that intuition is actually grounded is grounded in this, because it's your relationship between your realized vol and your it's your gamma theta relationship that's dominating your P&L when there's only a short period of time until expiry. But you want to think in vols as you kind of go further out in time. So this is so we can kind of see how that would, and actually we can do this. First of all, let's put another name in here. Let's put the calculation back on, and we'll put here. We'll put Tesla in here. Okay, so here's Tesla. Well, it looks like in the very beginning there was a big implied vol P&L. Not sure. That's actually, I'm kind of curious why that's happening. Okay, well, because I seeded the implied vol based on the function here at 99.8, and the vol dropped 6.8 vols on the very first day, and you're short 100 options. And remember, when you have almost 6 months to go, you can look here and you see, wow, I have the vega of these options is 56 cents. So every vol 1 point reduction in vol makes this option price lose 56 cents of its value. So this option price started as a 57. It was an at the money put roughly. It was almost a $58 option. Vol comes in 6 points on the first day on that strike. 6 points times 57 cents. You lose over $3 of just on that option value, just based on implied vol coming in. It was 5% of the option value got wiped out just on vol coming in on that day. And so that's what you're seeing here is like this giant vega P&L, basically implied vol P&L. And you can see how small the realized vol P&L is next to it. I mean, you can barely even see it on the chart. So your total P&L is being entirely driven by the implied vol P&L there. So anyway, so this is Tesla. What we're going to do is let's shorten the time here. So let's say this is March. You know what? Let's put in a fake expiry. We'll say like something next week. So here 225, the 225 expiry, and we're going to look at this starting on January. Let's do, you know what? Let's just make it February 1st. Okay. And then you can see here, well, let's make it look, there's not enough data points here. I'm not happy with that. All right, let's go back to 1-1. Okay. And you can see here, these red lines is the realized vol P&L, and that makes sense. Your realized vol P&Ls are having a very large impact on your total P&L, and that's because you're talking about a 1 month, more like a 7 week option in Tesla, and the realized vol P&L is starting to have a very large impact sort of on the back end here. It might have had a big one here because maybe the stock had the stock kind of had a large move here. And you see the same exact profile here, where if you move more than one standard deviation, that tends to be where you're losing. And then, so let's see, what else did I want to talk about? So otherwise I'll just kind of talk about this sheet a little bit. It's I'm going to publish this sheet for the paid subs tomorrow, so you can use it, you can tinker with it. Again, it's not a piece of software. It's just a spreadsheet. I mean, I tried to put care into it, but if a chart breaks or something while you're messing around with it, like you're just going to have to follow the arrows and figure out how it works. There's VBA, there's VBA behind the functions. But I try to, as best I can, to kind of keep all the computations transparent. And then I use name ranges a lot. The reason I use name ranges is because so the charts can dynamically update. A lot of the I felt like 75% of dealing with this spreadsheet was dealing with the display of the charts, and the rest of it was fairly easy to make. But here's a really useful thing. And and why I think this is a good tool for like the person who asked the original question. You can put in your own date override. So you could create your own series. If you put in your own dates in these cells, and you put in your own stock prices in these cells, and you put in your own option prices in the cells, you can do all that. As a matter of fact, if you put in your own option prices, this sheet will compute the implied vol for you for the option prices that you put in, because it knows all the other inputs. So it's going to generate the implied vols for you. But you can literally put in option prices. So if you had your own history of trades over time, like you shorted a put on some day and you have the daily marks, you could go in and stick in all the daily marks for your options. You could put where the stock price was every day, or you can just use the closing price, and you can put in your dates, and it will do the same exact thing. A couple caveats to that: you could only do one per day, and the idea of if you're frequently hedging, this sheet is inadequate, because if you think about all the Greeks, the way that they are here is like they are like on a per day basis. Like theta is on a per day denominator, right? So if you delta hedge, if you were to think about what's my realized vol P&L from noon to 3 p.m., you can't just look at your theta there. You need to you basically have to scale everything to the time period that you're looking at. Just the same way you have to deal with annualization in looking at returns. You're going to have to scale all your time periods, because Greeks, as they come out of the model, are on a like a per day time period or per vol point. Like vega is a per vol point metric. So I didn't put any thought into that, so that you're kind of this is a great starting point. You can kind of make that your own personal project if you like. You can override the strike as well. You can put in any strike you want, so and it will do the computation. So yeah. So anyway, you can completely override the simulation by putting in the option prices that you want to put in, and then you can see how you would have done had you hedged daily. Now, that's going to be my last point here. The question how do I see if my vol P&L evaluate my vol P&L? And we've explained how your vol P&L is the sum of your realized vol P&L and your implied vol P&L. But this realized vol P&L, we said it's the tug of war between gamma and theta. But the gamma, we're assuming that you're hedging every day at the close. But really, what happens is you are sampling your own volatility. Like any idea of like realized vol depends on the window that you're looking at, and so, or when you sample. So somebody could say, oh, look, the realized vol for the past week is 20%. But if you traded at prices that were not the closing prices, you have effectively sampled your own realized vol. So you can imagine this situation. You buy a straddle, and the stock closes every day at the same price. It's going to look, and if you run this, you're going to get killed on your long straddle, and your vol P&L is going to look horrible, because your realized vol P&L, you're going to get no positive P&L from your realized vol P&L. It's basically going to be theta completely overwhelming gamma P&L, with your gamma P&L 0 every day. However, let's say intraday, that stock went up, had a 3% range every day, and you happen to sell the top and buy the bottom every day. The realized vol, if you look in Bloomberg or anywhere it computes a realized vol based upon just the closing price, is going to show a vol of like 0, right? But you're sampling vol at a completely different realized vol. You are capturing 32 vol. If you're buying the low and selling the high, you might be capturing a 32 vol. So you might have bought this straddle for 20 vol, and you hedged on a 32, because you're really creating your own realized vol by hedging that way. So if you put that in here, then if you put those stock prices that you actually hedged at in here, not the closing prices, that is a reflection of the realized vol that you sampled. So, and you can imagine that this gets pretty complicated, because you can sample the vol, i.e. hedge multiple times a day. You could hedge just one time a day. There's any number of ways to think about this. So the realized vol that you sample is what's going to determine your specific hedged P&L. So when the user asked this question, is asking me I'm saying I'm benchmarking whether it was a good vol trade using a realized vol P&L that comes from what were the closing prices and assuming we hedged the closing prices. But that is an assumption. So anyway, that's really important. Is like everybody has their own realized vol P&L based upon when they hedged. So that's yeah, I think that's good enough for now. Like I said, for the paid subs, tomorrow's letter, I'll put a link to this sheet. I hope you mess around with it. I think this is probably one of the best ways to possibly learn about what understanding that options are about vol fundamentally. They're not just levered bets. And you want to, if you're not separate, if you don't understand your vol P&L, then it's really the same thing as being a general investor and not understanding how much of your P&L is coming from beta versus coming from actually doing a good job of picking your names or that kind of thing. Anyway, that's enough for now. Thank you very much. And this is going to be I'll upload this to YouTube. All right. Bye, everybody.